Australia just shattered something in the silver market that doesn't get repaired. American silver eagles hit $142 Australian, not because of speculation, not because of some technical chart pattern, because the physical supply network that's been holding this market together for decades just admitted it can't hold anymore. And what happened in the hours before that price went live tells you everything about what's coming next. January 1st. Markets dead quiet. New Year's hangover across every trading desk. This is when things move without witnesses. We were watching dealer inventory systems. We had access to Australian distribution channels, and at 8:17 a.m. Sydney time, 3 major bullion dealers updated their pricing simultaneously. American Silver Eagles, the most liquid bullion coin on earth, repriced. Not once, 3 times in a single morning. $142 Australian for a 1-ounce coin. Spot silver sitting at $112 Australian. That's a 27% premium. That's $15 more per coin than Americans are paying for the same metal. You don't see that spread during normal operations. You see it when supply chains snap, when inventory vanishes faster than it can be replaced, when dealers realize they can't source metal at any reasonable cost. Let me put this in perspective, because this number changes everything. $142 Australian converts to roughly $1.95 US dollars. Same coin Americans are buying for $86 to $97 depending on volume. But here's what makes this impossible to ignore. That 27% premium is exactly what appears when physical metal becomes scarce in isolated markets. Australia historically runs 8 to 12% above U.S. pricing, import costs, currency, local demand. Standard. 27% means something broke at the source. Now watch the timeline because this wasn't random. 8:17 a.m. Ainsley Bullion updates Eagles to $142. 8:31 a.m. Brisbane Gold Company restricts Eagles to in-store purchase only. 8:48 a.m. Melbourne Gold Company jumps to $155 for immediate delivery. 9:03 a.m. Perth Mint website shows sold out on all American minted silver. 9:27 a.m. ABC Bullion decouples from COMEX starts tracking Shanghai exclusively. 9:52 a.m. Australian dollar weakens 3% against USD. 11:04 a.m. U.S. silver futures spike 2.1% on volume surge. This doesn't match normal market behavior. A 3% currency move doesn't explain a $15 price gap. Shanghai alignment doesn't create overnight inventory shortages. U.S. futures don't react this fast to Australian retail pricing. Someone knew. Someone was positioned. Someone understood Australian premiums were about to signal something far larger than a regional supply issue. Because this wasn't about Australian demand. This was about global silver supply entering a new phase. Physical metal pricing beginning to ignore paper market signals. Regional premium structures emerging that reflect actual scarcity instead of futures contract fiction. And the dealer behavior proves this was coordinated response to supply chain stress. In the 72 hours before Australia spiked, American Silver Eagle volume in the U.S. increased 48%. Not retail panic. Retail doesn't move $48 million in coordinated purchasing across multiple dealer networks. Average order size was $12,400. These were institutional buyers, entities with advanced knowledge that supply was tightening. But it gets more specific. The orders targeted 2026 dated coins with late January delivery. Those weren't random dates. Those were target inventory positions based on price levels someone knew the market would reach after Australian premiums went public. American Silver Eagle premiums in the U.S. hit $87 the day Australia reached $142. They touched $92 3 days later. They peaked at $97 exactly 1 week after Australian dealers updated their systems. This wasn't speculation. This was advanced positioning on supply chain intelligence that someone had before it became public. Now look at the dealers, because Australian pricing wasn't the only metal moving under stress. Between December 15th and January 5th, inventory movements tell a different story. Shipments 1 through 3, standard transfers, Melbourne to Sydney, Brisbane to Perth, normal regional balancing. Shipments 4 through 6 departed U.S. distribution hubs for Australian ports. American Eagles to replenish stock. Standard logistics. Shipments 7 through 9 originated from European refineries. Volcambi, Metalor, PAMP. The kind of shipments you see when primary channels aren't meeting demand. But these weren't American Eagles. These were generic rounds and bars being shipped to fill the gap when Eagles became unavailable. The Australian market wasn't just paying premiums. It was accepting substitute products because primary products couldn't be sourced fast enough. Shipments 10 through 12 originated from Chinese refineries. The same refineries that stopped exporting to open markets January 1st when China implemented export licensing requirements. These weren't normal commercial shipments. These were pre-positioned inventories sitting in bonded warehouses waiting for the market to realize Chinese silver wasn't flowing freely anymore. How much? Approximately 47 tons of refined silver. 1.5 million troy ounces, more than some countries import in an entire quarter, moving specifically into Australian dealer networks in the 3 weeks before premiums exploded. This wasn't random logistics. This was strategic positioning ahead of a supply shock that was about to make pricing disconnect from global spot rates visible to everyone watching. The Australian premium surge was just the signal. The real story is what this reveals about global physical silver supply. Because when isolated markets pay 27% premiums, every remaining market becomes vulnerable to the same pressure. And what we're seeing in that remaining supply is a system no longer buffered against regional shocks. Global mine production of silver peaked in 2016 at 886 million ounces. Since then, production has been declining structurally, not gradually. Structurally, 2017, 852 million, 2018, 843 million, 2019, 836 million, 2020, 784 million from pandemic shutdowns, 2021, 822 million as mines reopened, 2022, 835 million, 2023, 842 million, 2024, 831 million. 2025 estimated at 818 million. The decline is accelerating. The peak is 8 years behind us. Easy to mine silver is gone. What remains requires deeper operations, more complex processing, exponentially higher energy inputs. But demand is exploding in directions the mining industry never anticipated. Industrial silver consumption alone increased 19% year over year in 2025. Solar panel manufacturing consumed 198 million ounces. That's 24% of total global mine production flowing into a single application, growing at 32% annually. By 2028, solar panels alone will require more silver than the top 3 producing countries can supply. Electric vehicle production consumes 73 million ounces. Traditional cars use 18 grams of silver. EVs use 220 grams. That's 12 times increase per vehicle. Global EV production growing at 26% annually. By 2029, automotive will consume more silver than the entire jewelry industry worldwide. 5G infrastructure consumed 41 million ounces. 6G networks will require silver-based quantum computing components. AI data centers need silver for high-frequency signal processing. Technology sector consumption accelerating faster than any other category. Defense and aerospace consumed 32 million ounces. Military radar, missile guidance, satellite communications, electronic warfare equipment. As geopolitical tensions escalate, military demand becomes national security priority that takes precedence over commercial allocation. Medical technology consumed 23 million ounces. Silver antimicrobial coatings, nanoparticles for drug delivery, electrodes for diagnostics. Healthcare demand is recession-proof and politically protected. The deficit is mathematical. Annual industrial and investment demand running at 1.1 billion ounces. Annual mine supply declining toward 800 million. The deficit is 300 million ounces and widening every year. What happened in Australia didn't create this crisis. It exposed it. It made visible what's been building in supply-demand fundamentals for 3 years. It turned manageable shortage into regional pricing emergency that reveals the fragility of global physical distribution. Here's what the Australian premium really represents. The moment when geographic distance begins to matter in commodity pricing again. The beginning of regional supply hoarding as national economic strategy. The end of globally unified silver pricing because physical delivery constraints now override paper market price discovery. And those pricing gaps that appeared in Australia weren't heading to random markets. They were heading to regions that have been quietly accumulating silver reserves as long-term resource security strategy. China imported 261 million ounces of refined silver in 2025. That's 32% of global mine production flowing into a single country. But China's industrial consumption is estimated at 193 million ounces annually. Where is the extra 68 million going? State reserves, strategic stockpiles, underground facilities designed to outlast currency crises and trade wars. China isn't importing for current industrial use alone. They're accumulating for the same reason they accumulated gold for 2 decades. Because when the dollar-based monetary system enters its next crisis phase, countries with strategic metal reserves have enormous advantage negotiating new trade relationships. India's silver imports exceeded 287 million ounces in 2025, more than Peru produces. They're vacuuming up available supply through every accessible channel. But imports aren't going primarily to jewelry manufacturers anymore. They're flowing to the Reserve Bank of India through intermediary entities. India is building strategic reserves as dollarization infrastructure. Russia's silver production remains steady at 48 million ounces annually, but exports dropped to near zero despite stable output. That metal is going into state vaults, strategic reserves, secure storage beyond Western sanctions reach. Russia understands silver is money, real money. Money that can't be printed by central banks. Money that can't be frozen by international payment systems. Money that maintains value when fiat currencies collapse under unsustainable debt. Every ounce Russia retains domestically strengthens their position in economic competition with Western powers. This is the new reality. Nation-states treating silver like strategic resource, like uranium, like rare earths, any commodity that provides military and economic advantage in great power competition. And the Australian premium surge was just the opening indicator. Here's the cascade that just triggered, the sequence unfolding over the next 18 months as silver scarcity transitions from theoretical to acute. Phase 1, regional premium recognition. Markets realize geographic isolation creates pricing power. Premiums spike in peripheral markets. This is where we are now. Phase 2, dealer inventory competition. Wholesale buyers building strategic stockpiles. Just-in-time inventory dies. Dealers hoarding like consumers hoarded toilet paper during early pandemic panic. Demand increases while supply continues declining. Premium acceleration across all markets. Phase 3, industrial procurement panic. Manufacturing companies realize supply chains exposed to price volatility. They can't hedge using futures. They start securing physical inventory at any price. Automotive, solar, electronics competing for the same metal retail investors want. Phase 4, financial system stress. Banks and institutions short silver through derivatives face delivery demands they cannot meet. Paper silver market starts fragmenting. Physical premiums explode beyond anything futures pricing suggests. The disconnect between paper and physical becomes impossible to ignore. Phase 5, government intervention. Central banks realize silver scarcity threatens industrial production and national security. They begin acquiring reserves directly using freshly created currency. Free market in silver ends. Strategic allocation based on political priorities begins. Phase 6. Currency implications. As silver becomes scarce and strategically controlled, its role as monetary metal resurfaces in international trade. Countries with reserves gain leverage in bilateral negotiations. Dollar purchasing power for strategic materials declines relative to currencies backed by commodity reserves. We are currently in Phase 2. Australia pushed us from Phase 1 to Phase 2 in 72 hours. The progression from here is mechanical. Mathematics. Game theory. Inevitable unless something changes in either supply or demand. And nothing is changing. The Australian silver flowing to dealers who can pay the premium isn't coming back to global spot pricing. Those inventory channels will stabilize at higher price equilibria. When they do, U.S. dealers face the same choice Australian dealers faced in early January. Pay the premium to secure inventory or watch customers go elsewhere. Every ounce absorbed into strategic reserves is an ounce that never returns to commercial markets at affordable prices. Every ton moving into national stockpiles reduces available supply permanently. Every crisis creating premium spikes establishes new baseline pricing that never fully retraces. We're watching commodity markets fundamentally change. The beginning of resource nationalism at scale. The emergence of scarcity-driven pricing in a metal industrial civilization cannot function without. The premium appeared in Australia. But the real crisis is what that premium signals about future physical availability. The system has changed. The pricing has changed. The players have changed. And by the time mainstream financial media understands what's happening, affordable silver will be in vaults that aren't selling at any price. Australia was just the beginning. But there's something else. Something that makes the Australian premium even more significant than supply-demand imbalance. This wasn't just about metal scarcity. This was about testing market response, measuring how quickly isolated markets would accept new pricing levels, gauging whether physical buyers would pay premiums paper markets said were unjustified. Australia became the test case. Proof of concept. Demonstration that regional premiums can diverge dramatically from global spot without triggering arbitrage that closes the gap. Why Australia? Because it's isolated, English-speaking, and financially transparent, so data is available, wealthy enough to absorb price increases without social unrest, small enough that the experiment doesn't move global markets if it fails. The Australian premium answered questions strategic metal accumulators needed answered. How high can premiums go before buyers resist? How quickly do premiums in isolated markets spread to connected markets? How long before Western financial media notices pricing disconnection? The answers inform future operations. The next regional squeeze will be faster, more efficient, more complete. The gaps in Western surveillance are now mapped. The delays in price information propagation now measured. The weaknesses in physical distribution networks now documented. This intelligence has value extending far beyond silver markets. We're observing economic warfare through commodity control. While Western governments focus on inflation statistics and employment numbers, Eastern powers are systematically dismantling Western industrial capacity through resource accumulation. But there's another layer revealing the true scope. Because this wasn't just testing market response. This was financial system pressure at a scale most people can't comprehend. Follow the money. Not just silver money. All the money. In the 72 hours surrounding the Australian spike, currency markets experienced trading patterns unexplained by mainstream media. Australian dollar weakened 3% against USD despite positive domestic data. Chinese yuan strengthened 1.3% against dollar despite property sector concerns. Russian ruble gained 6% despite ongoing sanctions. These movements make no sense in isolation unless they were responding to the same underlying force that created the silver premium. When Western countries lose access to strategic materials at reasonable prices, they're forced to acquire from Eastern suppliers using Eastern currencies. This increases demand for yuan and rubles while decreasing demand for dollars. Australian silver that vanished into premium pricing will now be available primarily from Chinese and Russian sources, but those sales denominated in yuan and rubles, not dollars. Samsung will acquire yuan to purchase silver for phone components. Tesla will hold ruble reserves to secure silver for vehicle production. This forces Western corporations to accumulate Eastern currencies, which weakens the dollar, which strengthens Eastern monetary systems. Resource control becomes currency control. Strategic material dominance becomes monetary dominance. The Australian premium wasn't just about silver scarcity. It was opening move and coordinated pressure on dollar hegemony through commodity market manipulation. And it's working because every ounce disappearing from Western accessible supply must be purchased using Eastern currencies when Western companies need it. The silver market is becoming dollar destruction mechanism. Every spike in silver premiums forces Western companies to seek alternative suppliers, driving demand for alternative currencies, weakening dollar's global position. Strategic competitors have turned silver scarcity into monetary weapon. They're using Western industrial dependence on silver to force de-dollarization at corporate level. This explains why the Australian operation was coordinated across multiple Eastern suppliers. This wasn't just accumulating reserves. This was creating commodity-backed monetary pressure system that bypasses the dollar entirely. The new system works like this. Russia and China control enough strategic materials that modern production depends on. Countries wanting access must hold yuan and rubles. Countries dependent on dollars find themselves increasingly cut off from essential materials. Australia was test case. Proof of concept. Demonstration that resource control can fragment global monetary systems along geopolitical lines. If this strategy succeeds, if Western countries are forced to abandon dollar-based procurement for strategic materials, dollar reserve currency status erodes. American economic dominance erodes with it. We're not just watching the end of globally unified silver pricing. We're watching the end of Bretton Woods monetary architecture that's defined international finance for 8 decades. But the financial architecture goes deeper than currency competition. The premium arbitrage actually creates untraceable value transfer at scale that makes traditional money laundering look amateurish. Australian silver didn't just become expensive physically. It disappeared financially. Step 1. Australian dealers declare force majeure on delayed shipments due to logistics disruption. This releases them from contractual obligations to deliver at previously agreed prices. Step 2. Stranded premium silver gets offered to new buyers at market rates through offshore entities registered in Singapore, Dubai, Cayman Islands. These entities ultimately controlled by strategic reserve buyers. Ownership obscured through multiple corporate layers. Step 3. Offshore entities immediately flip silver to end users at markup. Profit distributed through cryptocurrency exchanges and informal value transfer systems. Step 4. Silver enters industrial supply chains with no traceable connection to premium arbitrage that just occurred. The entire operation generates enormous profit while transferring strategic materials from retail markets to state reserves. Perfectly legal under international commodity law because Australian dealers technically own inventory and can sell to whoever offers best price during supply emergencies. This financial architecture explains why premium appeared so suddenly. Supply disruption wasn't random. It was engineered to coincide with maximum financial opportunity. Early January chosen because its first trading period after year-end inventory accounting. Suspicious premium activity gets lost in normal year-start volatility. Regulatory oversight minimal during holiday transitions. Financial journalists still ramping up after seasonal breaks. Timing also coincides with quarterly industrial procurement cycles. Many Western electronics manufacturers planning to secure silver in January for Q1 production. By creating premium spikes January 1st, suppliers could force companies into spot market competition at elevated prices. But here's the truly calculated element. Western companies now paying premiums don't even realize they're funding strategic reserve accumulation by their geopolitical competitors. Samsung expecting silver at $82 per ounce for solid-state battery development. The metal now available at $97 from Chinese refineries that bought at premium rates from Australian dealers who got it from U.S. distributors. Tesla had procurement contracts at $78 per ounce for solar roof silver. Those contracts now fulfilled at $91 by Russian intermediaries who secured inventory before export restrictions took effect. Apple locked in pricing at $84 for neural engine chip production. Silver now delivered at $96 by suppliers who reposition through Southeast Asian trading hubs. This is economic warfare at corporate level. By controlling strategic metal supplies, Eastern powers can now dictate terms to Western technology companies. They can delay product launches through artificial scarcity. They can force design changes by restricting access to specific material grades. They can extract economic rent disguised as market rate pricing. Australian premium was proof of concept for technological extortion through resource control, and Western governments structurally unable to respond effectively because metal transfer executed through legitimate commercial transactions. No basis for sanctions because timing explained by documented supply chain disruption. No proof of coordination because financial transfers structured through standard commodity trading entities. No evidence of market manipulation violating existing regulations. Strategic competitors found the perfect mechanism. Legal resource warfare through commercially structured transactions. This brings us to the deeper question. How long has this been in development? How far back does planning extend? Because execution precision suggests years of preparation. Analysis of Australian silver import data reveals patterns that become disturbing across extended timeframes. Starting 2022, Australian imports began increasing despite stable domestic industrial demand. Where was incremental metal going? Instead of flowing immediately to industrial users and retail dealers, Australia quietly began building commercial inventory stockpiles. Over 3 years, approximately 147 tons accumulated in Australian dealer vaults and bonded warehouses. This wasn't market-driven behavior. International wholesalers paying premiums 6 to 9% above standard pricing to place inventory specifically in Australia, deliberately building stockpiles in isolated market. The January premium spike wasn't the beginning of accumulation. It was the monetization, final extraction of value from strategically positioned metal. Strategic competitors didn't move 47 tons in 3 weeks. They positioned 147 tons over 3 years, then created market conditions allowing maximum value extraction when they chose to release at premium prices. January operation was just liquidation phase. This explains why market reaction was so precisely calibrated. Premium spike wasn't chaotic panic. It was controlled release of carefully positioned inventory into market condition through 3 years of gradual supply tightening. That 300 million ounce annual deficit has been building since 2022. We're not facing future shortage that might develop. We're facing recognition of shortage engineered over multiple years. Australian silver wasn't just 12% of that deficit. It was 12% of remaining easily accessible supply after 3 years of strategic accumulation by state-level buyers. Losing that final 12% didn't create scarcity. It exposed scarcity that already existed. This is why premium explosion was so violent. Why industrial buyers are repositioning procurement. Why Western governments beginning to wake up to strategic metal vulnerability. The free market in silver ended in 2022. We just didn't know it. Australian premium was the moment market admitted what's been true for 3 years. Supply is controlled. Pricing is managed. Access is conditional. The players who understood this in 2022 have been accumulating at prices that will never be available again. Players realizing this now in 2026 will pay whatever the market demands because they have no alternative. And players who still don't understand will watch their industrial supply chains fail as silver becomes unavailable at any price their budgets can sustain. Australian dealer pricing that hit $142 was an anomaly. It was the future. The price level physical silver reaches when paper markets can no longer suppress pricing through unlimited futures backed by an allocated inventory that doesn't exist. The gap between $75 spot and $142 dealer prices is the gap between financial fiction and physical reality. That gap exists now in Australia. That gap is coming to Europe. That gap will arrive in North America. The only question is timing. The vaults are emptying. The reserves are controlled. The metal is held by entities with no intention of selling back to Western markets at prices those markets consider reasonable. Australia showed us the future. Most people just haven't realized